Imagine this. You wake up on a normal weekday morning. The currency in your country has been stable for as long as you can remember. Prices don't jump overnight. Your savings account shows the same number it did yesterday. The news talks about politics, sports, scandals, but never about the currency. Why would it? Nothing is wrong. This currency has survived wars, elections, protests, and global crises. Experts call it resilient. Governments point to it as proof of responsible management. Banks market long-term deposits in it. People plan their futures around it. And then, without warning, something changes. Not a dramatic announcement, no official declaration of collapse, just small signs. A bank delays withdrawals. A temporary restriction is introduced. An exchange rate that used to be fixed starts to slip, just a little. Officials call it a technical adjustment. They promise stability will return. It doesn't. Within months, sometimes weeks, the currency everyone trusted for decades is no longer the currency people want to hold. Savings are trapped. Prices reset daily. A parallel market appears, then becomes the real one. The collapse doesn't arrive like an explosion. It arrives like a quiet realization. The most dangerous currencies are not the ones everyone knows are weak. They're the ones believed to be unbreakable. Today's story is not about reckless hyperinflation states or obvious failures. It's about currencies that didn't collapse until they did. Currencies backed by credibility, history, and confidence, right up to the moment that confidence snapped. To understand how this happens, we need to look at history. Not predictions, not opinions, just patterns that repeat, quietly. For much of modern history, the British pound was not just a currency, it was the currency. In the 19th and early 20th centuries, sterling sat at the center of the global financial system. International trade contracts were written in pounds. Central banks held it as a reserve. London was the financial capital of the world, and the pound's credibility was tied directly to the power of the British Empire itself. And for a long time, it worked. Even as other currencies failed, the pound appeared unshakable. Britain survived wars, recessions, and political upheaval without a sudden monetary collapse. This long record of stability created a powerful illusion that sterling could bend but never break. The collapse, when it came, did not look like hyperinflation. After World War I, and especially World War II, Britain emerged victorious, but financially exhausted. Massive war debts, declining industrial competitiveness, and the cost of maintaining a global empire strained public finances. The pound was still treated as a world reserve currency, but the economic foundation supporting that role was eroding. Rather than allow an immediate adjustment, British policymakers chose defense over correction. Exchange rates were managed, reserves were spent to maintain credibility. Temporary measures became permanent habits. In 1949, the pound was officially devalued. Again in 1967. Each time, officials framed the move as a one-off correction. Each time, confidence weakened further. The real collapse of sterling was not a single event. It was a loss of status. As the United States emerged as the dominant economic power, the dollar replaced the pound as the world's reserve currency. Central banks gradually reduced sterling holdings. Trade shifted. Capital followed credibility. Britain retained its currency, but it lost its monetary dominance. This is a crucial lesson history offers quietly. A currency can survive in name while collapsing in function. The pound did not die, it faded. And for British citizens, that slow decline meant repeated devaluations, shrinking purchasing power, and decades of adjustment to a lower standard of global influence. Sterling's story shows that collapse doesn't always arrive as chaos. Sometimes it arrives as irrelevance, one policy decision, one devaluation, one credibility loss at a time. In the next case, the pattern accelerates. The illusion of stability holds until it breaks all at once.
The message was simple. This currency is safe. The peg became a psychological anchor. People stopped questioning it. But stability built on a peg is only as strong as the reserves and institutions defending it. Lebanon's economy was quietly deteriorating beneath the surface. The government ran persistent fiscal deficits. Public debt ballooned relative to the size of the economy. Instead of productive investment, growth depended heavily on capital inflows, money sent from abroad by the Lebanese diaspora, and short-term deposits attracted by unusually high interest rates. The banking system became the engine of this illusion. Banks took short-term deposits and funneled them into long-term government debt, earning high yields while promising depositors safety and liquidity. As long as new dollars kept flowing in, the system held. The peg survived not because the economy was strong, but because confidence hadn't yet broken. Then the inflows slowed. Political instability increased. Regional conditions worsened. Trust weakened. To defend the peg, the central bank burned through foreign currency reserves. This worked until it didn't. In 2019, the illusion cracked. Banks quietly began restricting withdrawals. Temporary capital controls were introduced without legislation. Official exchange rates stayed fixed on paper, but a parallel market emerged almost overnight. The real value of the currency was no longer what the government declared, it was what people were willing to accept. Once that shift occurred, collapse accelerated. The peg unraveled. The pound lost over 90% of its value. Savings denominated in local currency were effectively wiped out. Even dollar deposits were frozen, converted, or rationed. The stability that had lasted decades vanished in months. Lebanon's collapse illustrates a brutal truth. Pegs don't fail gradually. They hold until the moment they snap. The mechanism is consistent. A fixed exchange rate masks fiscal weakness. High interest rates attract capital temporarily. Reserves are used to defend credibility. And when confidence breaks, losses are forced onto the public through devaluation and restrictions. The Lebanese pound didn't collapse because it was obviously weak. It collapsed because it was trusted for too long. In the next case, we'll see what happens when governments try to manage instability continuously, and why repeated intervention eventually makes collapse unavoidable. Not all currency collapses arrive after decades of calm. Some emerge from a different illusion, the belief that instability can be managed indefinitely. Argentina and Turkey represent this model. Argentina has experienced repeated currency crises for more than half a century. Inflation surges, devaluations, and restructurings are not surprises. And yet each cycle is treated as temporary. New controls are introduced. New pegs or quasi-pegs are announced. New promises are made. Stability is always said to be just one reform away. The mechanism never changes. Large fiscal deficits are financed through money creation. Inflation rises. To contain it, governments impose price controls, capital restrictions, and managed exchange rates. These measures briefly slow visible pressure, but they also distort behavior. Businesses raise prices preemptively. Citizens shift savings into dollars. A parallel exchange rate emerges and steadily becomes more relevant than the official one. Over time, expectations change. Once people expect depreciation, policy loses power. Even aggressive controls cannot restore confidence because the public no longer believes official numbers. The currency doesn't collapse in a single moment, it erodes continuously, punctuated by sharp resets. Turkey followed a similar path, but faster. For years, the Turkish lira was defended through intervention and rhetoric. Inflation was redefined, not defeated. Interest rates were held below inflation, encouraging credit growth while discouraging savings in local currency. Each intervention delayed adjustment, but also weakened credibility. As inflation accelerated, behavior shifted. Citizens moved into foreign currency and gold. Businesses began pricing in dollars. The currency didn't disappear, but it stopped functioning as a reliable store of value. This is the defining feature of controlled instability. When governments fight symptoms instead of causes, they train the public to exit the currency system. By the time policymakers attempt serious reform, trust is already gone. Argentina and Turkey show that collapse does not require surprise. It can happen in full view, over many years through repeated promises that stability is returning, while behavior proves otherwise. The lesson is clear. Currencies fail not when governments lose control, but when people stop believing control exists. Next, we'll distill these histories into a framework, the warning signals that appear before stability finally breaks.